Today I'm joined by Sean Wilson, CEO of BuildDirect.com.
I kind of just hopped on the wagon, right?
His company is taking on the $90 billion flooring market by rolling up smaller players, building pro centers, and using e-commerce to win share.
There's nothing like buying a project from the pro who's installing it.
Sean has led at the Home Depot and Mohawk, and he thinks like an investor when it comes to growth and capital allocation.
It shouldn't be inbound to me, it should be outbound what's interesting.
In this episode, we dig into how he's scaling BuildDirect, what makes his strategy work, and the lessons he's learned along the way.
You're like taking me back to my past here. Pretty soon I'll have memories of my long blonde hair.
On the investment side, I get excited with a 1-year payback, 2 years max. Otherwise, why bother? So how do you find such opportunities, and why isn't PE already going after them?
I think about investments that way, candidly, if it's something we're doing organically or acquiring or restructuring, kind of things like that. And I would say it's kind of two parts. So first off, it's what you're going after. And then second, how you're going after it, like how you're actually structuring a deal, whether it be with like tail end earnouts or if it's mostly an asset deal. Then from there also how you're valuing the assets and if the assets are more attractive, more valuable within your own network versus where they might exist today. So kind of applying that thinking, the approach is pretty much the same across wherever we're doing, and then modeling things out in different ways. I find like on the other side, like trying to find ways for a deal to make sense is kind of like, I'm reading The Art of War again, like one of my favorite books. Like that's like starting a fight and then trying to figure out how to be successful once you've already started. I'd much rather have a step back and see a path to victory on the forefront and then kind of work through it from that side.
Nice. And can you also expand on why these opportunities actually exist? Because if one reads your press releases or studies a bit your reports, one can tell and actually do the math that you're actually paying these type of multiples, right? And so why do these opportunities exist, and why is PE not going after them already?
I think there's such a massive amount of opportunities out there. One of the challenges on like the large strategic side or private equity side is also being able to do deals that are large enough to justify, the folks involved, the fees, kind of things like that. And so I find whether it be in flooring or candidly a variety of many businesses, the type and size of deals that we're going after, there's just so many of them out there. And having a way of executing those deals and pulling them into your broader network in like an efficient way that really retains value is what it's all about. And so I would say when it comes to private equity, what I've seen at least is typically a preference towards larger deals, $50, $100 million revenue opportunities. There again, a lot of times that's based on the fees they have to earn to make the deal make sense. But I would say that's, it's kind of the norm. And here again, that's not just in the flooring industry. It's in a lot of, service, building material, other type of industries that have a heavy inventory component that's difficult to value outside of its value chain.
Got it. Perfect. So jumping right into the next question, I have another quote which I really enjoyed. One of BuildDirect's core values is acting like an owner. I find this often the hardest value to screen up front. But conversely, it's the easiest to identify after hiring, observing decisions and mindset. You can be a lot of great things, but in our organization, you have to be an owner. So how do you educate people on having an owner mindset? And how do you actually do it on the acquired businesses? Because it's one thing to educate your own people, but you're adopting a whole new team as well. So how do you educate them into an owner mindset?
So I don't believe organizations have culture. I think culture at that level is the aggregate of the individual team members. And so when we're looking at acquisitions or even bolting on a lot of team members for an organic play, making sure that it fits in, will have a positive influence on driving our culture, our values forward is a, really is a huge thing. That's a big part of the screening process. And so when you're looking at, five different deals, there's, the inventory quality, there's the market presence, but it's also, in my opinion, most importantly, the team members that you're bolting on, because their point of view, their values will also translate to how they service our local markets and how they interact with your team. So it's a very important part. I would absolutely say over the years, here and elsewhere, I passed over deals based off of that. It's a really important part. When it comes to when it comes to evaluating that from the outset, yeah, as I mentioned, it's a difficult thing to assess. You have different like comp structures that you could have for team members that are, like long term incentivized, things like that with options, or or just documents. But really, when it comes down to, will team members act on in the best interest, and they help move things forward? That's really something you have to observe, in my opinion, when they're actually progressing, making decisions, placing bets, managing workflow, and really things like that. And then with that said, I would say we have a lot of team ownership at our company. If you look at kind of who owns the shares of our company, we have quite a bit of our management team, and general team that really have a significant amount of ownership. That's a really important thing for us. So I would say really, we're very big on making decisions from that mindset, but then also along with that, having the freedom and autonomy to make those decisions. So having the right people who can make the right calls and place bets, and really have the organization's health at the forefront versus individual career or ego motives, kind of things like that. Empire building, that's really not for what we're doing.
Got you. So it's interesting to know that you note that you actually look at the people component when acquiring these businesses, and you factor that in the whole
Most important
equation.
part. Yeah, most
Yeah,
important part.
for sure. If there's one thing I've learned from these conversations, like the one I'm having with you, is that people really make the difference. And so, yeah, that's a key pillar of every single organization, right? Um, nice. So jumping more into the M&A strategy and roll up execution, I would love you if you could explain the what's the M&A strategy, and why does it work well in the flooring industry specifically?
Yeah, so I'd say, kind of to back up, we have three growth tracks we've talked about on our last earnings call. The first one is our organic track, where we are committed to scaling up our e-commerce business now that it's been reformatted and is in great shape. Along with that, we're layering on new marketing programs that we've been testing in the background for the better part of a year. That's are really panning out. On the acquisition side, so there's two tracks there. One is our bolt-on track, where uh, for the industry that we're in, those are companies that are probably around 5 to 10 million, maybe a little more than that in revenue. One location, maybe two locations, and we can just bolt those on to our BuildDirect business, where we come in, replace systems, put in process, so on and so forth. Branding is all BuildDirect, and we convert that facility. That to me is one of the most exciting things that we can do. We have instant traction in the local market. We're giving those new team members a lot of strength with our brand, procurement model, marketing, kind of things like that. And that's what we did in our last acquisition in Orlando. The third track are large, what I call division acquisitions, where we're buying a larger business, let's say between 25 to 45 million, kind of in that range. And businesses like that, you're not going to quickly integrate them. They're going to have their own systems, process, value chains, and they could have some overlap with obviously the flooring industry is what we're targeting. But There could be different customer overlap, but really those acquisitions, they're a bit pricier, and they have to have net new synergies that come, or sorry, capabilities that come with them. So, like for example, adjacent categories or meaningful access into incremental uh, pro segments. And so we're thinking about growth in through those three ways, on acquisitions in those two ways as I've broken out.
Got it. And can you sort of explain what's your criteria when going after these acquisitions? Obviously, you explain if it's like more of a bolt-on, you can quickly integrate them. Whereas it's yeah, the bigger ones, it's harder to do so. But generally speaking, what are you looking for when acquiring these businesses? And do you have a checklist, or yeah, at least in your mind?
Right. So on the bolt-ons, I think this is what makes us very unique for these deals. We're not looking for really systems like ERPs or CRMs. In fact, if they don't have those, it's kind of preferred. So we much rather just bolt on our software, very clean and very easy. And so the main thing we're looking for with those is a local presence, good solid customer relationships, repeat customers, and then also that that being focused on a pro segment, whether it be commercial, restoration, institutional, so on and so forth. That's the main thing I would say there. On the procurement side, uh, companies are not going to have a a leaner and more cost efficient buying model. And when it comes to marketing, the same thing really applies. And so, for us, really, it's about finding the businesses that have a local pro uh, reputation and have a long track record of serving pros well. We come in and like leverage that as a starting point. On the larger deals, this one gets interesting because, as I mentioned, even with the small ones, the larger companies, you're not going to find, be very surprised to find companies that have a more, like a better supply chain than we do with our direct procurement model. And then when it comes to like systems, for the most part, the flooring industry has consolidated the ERPs and to some extent the CRMs, if at all, that are utilized. And so you just kind of find these larger businesses typically are just kind of more of the same of the smaller ones, maybe just one or two levels up in sophistication. Like, for example, they're using an industry ERP versus QuickBooks. Perhaps they have a CRM, and then they do bulk buying from distribution, maybe a little import, but not a lot. So with that, the track of the larger acquisitions, like with those, what we're looking for are net new capabilities. But those net new capabilities more than likely won't be in the flooring industry. They'll be in an adjacent category, for example, like countertops, trim, cabinets, kind of things like that, where we have an existing customer base who has overlap with those categories. And so when we're looking at those types and size of businesses, that's what we're looking for are net new capabilities at that level.
Okay, got it. Makes a lot of sense. And what's the biggest mistake you've seen other roll-up strategies make, and how are you actively avoiding it or avoiding them?
Yeah, this is a fun question. So my career started at Mohawk Industries, and it was a great place. It was a great place to work and get experience in the flooring space. I was there for a long time, and Mohawk during those years was acquiring the manufacturing level a variety of different companies. So for example, they acquired Dow Tile, Marazzi, Pergo, Unilin, so on and so forth. And then, really I got to see how the different companies interacted, right? We're able to leverage a handful of core capabilities, but then aside from that, on the integration side, being cautious not to um, integrate away the value that you acquired. And so I'd say kind of, first off, I think when it comes to acquiring, one mistake that companies can make is having a bias towards the acquirer versus what was acquired. There's a great, like, super nerdy research paper on this I read years ago. Uh, it's called like the what was it called? Uh, Something about the acquirer's dilemma. Like, if it's talking about how the company who was bought built something valuable enough for someone else to buy, and not taking that really too lightly, but learning from that and pulling capabilities that you acquire back out into the broader organization. So I'll give you an example. BuildDirect acquired FloorSource in Michigan, and we worked with them to create the footprint for our organic build locations. They're heavily influenced that initiative. The most recent acquisition we did in Orlando, there were some key things that business was doing. Although we're able to bolt on our systems and process and procurement, there are a lot of great things that business was doing that we then started pulling up into the broader organization. So I would say, really, from the standpoint of not integrating away the the valuable parts of those businesses is probably one of the first big things. The second thing I would say is just a loss of span of control. So when you think about, especially in distribution type businesses or inventory heavy businesses, where you have multiple different uh, buyers that are buying across the organization, you can have inventory creep, you can have SKU creep, you can get kind of tripped up in uh, just having a lack of coordination done there. And so you want to have a balance between local autonomy and decision making, but also really capturing and leveraging key synergies. So for us, those two key synergies are procurement and then marketing. Those are the two things that we push pretty hard on to work together. And then along
Mhm.
with that, we have an overarching approach to how we run the different businesses. When we bring in new managers or buy new businesses, we train them on how we operate the systems that we use, not like computer systems, but like the business management systems, uh, cadence, things like that. And so we try to really instill that within the broader team as well, so that we're pulling them together, can communicate, um, and kind of work through our org strategies, yeah, in an efficient way. So I think that's where I see, for example, there's quite a few targets on the list that come our way that were themselves roll ups, and where they often went wrong uh, is what I mentioned before, where they pull these businesses together, and then the value add kind of went away. And then the second piece, just losing the span of control and having issues on the financial side. One business is recognizing revenue, one way, one is the other way. They have an issue with how they're recording inventory, and then they have a problem with their their debt partner, kind of things like that. So that's where we're focused on being sharper and making sure that we protect on both fronts there.
Hmm. Got it. Got it. Yeah, it's definitely very important to learn from these other failed roll-up strategies, because it's not just in the floor industry that you see failing roll-ups that then need a turnaround or something, and those setups can actually be interesting from a valuation standpoint if you have the right tools to fix them, right? And it feels like you already have the systems in place to come in and actually know what to do. So that feels very valuable. Um, on another point, your thesis seems to be that there's enough of these small mom and pop businesses that you can acquire at attractive valuations. And so I wanted to ask you how your pipeline is looking right now, and whether you're on track on what you wanted to achieve this year, or you're looking to accelerate the pace going forward.
Yes, I would say we're on track for what we want to accomplish this year. And yes, there's definitely not a shortage of great viable targets that are out there, and we're just working through those. We're mainly focused on higher growth areas within the U.S. So I think the Sun Belt as a kind of primary area that's of interest, but we're also open to the right opportunities elsewhere. And so, for us, facility in Orlando was kind of step one, and look for that area really, really in the future. The second part that I mentioned, and I don't talk about this a lot, but I mentioned quite a few times more recently that we've been working through a variety of marketing programs and that are gaining traction. And so, with that stated, the more we improve on that front, the more bias it might become on building or building the quasi, buy build. Uh, so if you think about it, when you're buying in the market, if the main thing you're acquiring are existing customer relationships with pros, that's the main thing. And then from there, you're looking for the right team members and you're plugging in systems, this, that, and the other. If you kind of put that in the in the focus area, if you have other ways of achieving that, that's literally how we think about it. Is, are there other ways to achieve that? Then it could change the calculus quite a bit on really what makes sense between building and buying. And we've seen that where we've had target markets and we've leveraged our e-commerce business to create a foothold in those markets. And so that's what really gets me excited as well, is having alternatives for market entry, whether it be acquiring, whether it be organic, so on and so forth. But yeah, definitely no shortage of targets. If anything, it could be the opposite at times. Too many options, which can be the enemy of decision, of course.
Makes sense. And so, from what I understand, it might actually be a better sign in the future if you are building versus acquiring. I don't know if I got it right, but uh, maybe investors associate a lot the thesis of BuildDirect to M&A, but from what is you said, basically it might start to make sense to actually build, and it might be cheaper than acquiring, right?
It could be, yeah, definitely could be. I would say a good way of looking at us, I've laid out like our three main growth tracks and what gets us excited on returns. And so when we're making moves with any one of those growth tracks, that's what's on our mind. Even if it was like a larger deal, there was a path there. Like, so for example, if you bought something, yeah, I paid a bit more for it, it was a larger deal, but it had like a net new category, our ability to pull that category across the other locations pretty fast would be part of how we would think about the value for that deal. And so I would say, like, I'll give you an example. There was one roll up, I can't recall the name of it. It was in, I want to say it was in Canada, and it was focused on like D2C e-commerce companies. And the thesis was, hey, look, starting these businesses is super risky, very expensive, very difficult. So this roll up was just going to go in and buy the survivors, right? Like, the ones that found product market fit and had a model, so on and so forth. I do find at times that's what some roll ups are. I have a hard time with that. Like, I don't think I mean, I don't like having the potential for expansion being controlled by some outside thing or force. And then on my end, it's not, do 10 acquisitions, roll up a bigger company and call it a day. No, want the runway to be infinite. Which it pretty much is. And so, I would say when you think about us, we use M&A as a market entry tool, um,
Right.
and what more than anything else. But you better believe when you're using something as a tool, you have to have a BATNA, like something that's highly desirable. In my opinion, you should never buy what you can't build. I'm very biased there.
Why?
And so you should be able to build what you want to buy, and you should only buy it if you could buy it for better than you can build it. And it literally is that simple in my mind.
Okay. Yeah. Yeah, that definitely makes a lot of sense. And I wish more CEOs thought like that, because sometimes acquisitions are a way to, I don't know, just boost your ego, or something like that. Look how big of an acquisition I made. It seems like it from the outside. Obviously, we don't know what goes on in their minds, but yeah, it would be much more efficient if everyone thought like that. Um, Actually, just as a small follow up, how do you think about the velocity in acquiring these businesses? And also, we've spoken a bit about price discipline, so maybe you can focus on velocity. But yeah,
Yeah, so I would say, the model company for this kind of play would be Constellation. Like, I'm a huge fan of how their acquisitions conduct acquisitions, right? Like, they built a great model for being able to pull in a lot of these, smaller and larger companies, but lot smaller companies into the fold. And so the intent there is we're building out our team, as what we've been very mindful of. Like, frankly, our different divisions are run by very qualified, great folks, great teams who can pull in as well as larger bolt-ons at the platform level. So, I would say that we're targeting to increase the velocity, um, and we're just kind of on the outset getting a very firm footing, as well. So we've been, from a speed perspective, with all the it's funny because, like, as of Friday, I was going to say, of all the tariff noise out there, and then today it's even more different, right? We were, being a bit cautious on waiting to see how things shook out, because it does influence, what type of deals you do, because different people, different companies buy from different places, and different categories and geographies, so on and so forth. But um, I would say, for the most part, yeah, our intent would be to pick up there. Now that we had, a lot of that noise kind of dissipate, and who knows, maybe it'll just go away altogether. Time will tell.
yeah, exactly. Time always always tells. So I'm also curious on another note to know if you're planning to issue more equity in the future, or do you have what you need to fund all deals with incremental debt and operating cash flows?
Yeah, so I would say we definitely at this point don't have any intent on additional equity at this time. And then I would say, like, the way we think about the types of things that get us excited, they're typically asset based, usually heavily covered by inventory, current AR, kind of things of that nature. When we open up a location, there's not a lot of expense. It's just working capital, and so I would say on that front we get much more excited around that. And then, hey, things change, and so if something changes and there's an opportunity that makes a lot of sense, that requires using equity as well, then that could fit into it. But you better believe there's a you know heck of an opportunity based on what we're seeing and how we're valuing the deal. So I would say, and maybe it might make us a bit different. We
Yeah,
we do view our equity with a lot of scrutiny. A lot of scrutiny. It's our most valuable resource for sure. And with that, it's doing things that are short term, or conserve cash but cost you three times that amount on the equity side. I see that a lot, where you see deals done and the intrinsic value for the asset uh, might be different than where the deal is done at, and all you can think of is, geez, that was a short term decision that was made. I was talking to obviously, won't name the company, but I was talking to the CEO of another company, who, when I was pressing why they did an equity deal, it literally just came down to, it was fast, easy, and good enough. It just shocked me when you think about, like,
yeah,
you think about that, right? So I would say, from our mindset perspective, that's not kind of how we think about it, view it, and how we operate, which it could drive some folks nuts, right? Like, we could ask questions on, hey, what are you doing to improve your liquidity? And the answer is nothing. I focus every day on building a business. And if people want to buy the shares and never sell them, great. Um, we don't focus on those other parts or games or things. It's just literally about building a great business.
This is maybe an unrelated question, but I wanted to ask you how you learned to think in those terms, right? Because it almost seems like I'm talking to an investor when I listen to you. So, um, do you actually study the great investors, or yeah, where do you learn those frameworks, and maybe how could other CEOs learn as well?
Yeah, so not super complicated. Just have the benefit of having a great, some great mentors around, and have for for quite a while, and then with that, like most people in the space, just a very active reader, very active reader, and so I would say what one of the best books on the topic would probably be Private Talk. It's a an older book, but a great book. And when you're thinking through, when you're thinking through like taking a strategy to market, which might be a different way of thinking about it, but I view a lot of things that you're doing as a strategy, and they have a vehicle that uh, is being used for that strategy. And so, like in our case, the strategy is building the largest pro focus flooring business in North America. There's some reasons why. Like, there's some really strong reasons why the pro focus makes a lot of sense, and then having BuildDirect be the vehicle, like a great vehicle, for that. If you think about it in those terms, it changes your mindset on, I think, what you're doing. Like, you're instead of just trying to get something accomplished, you're thinking about at what cost. And the innovation is not in what you've accomplished. Like, you see companies who grow to $1 billion that have massive dilution, and sure, you got to where you're getting, but was that like the way you got there, was it capital efficient? And so I would say kind of first and foremost that. Second, look, I am an investor. Uh, both in this company and also in others. And so I think that mindset comes from active participation. Um, you know, and thinking about things from the standpoint of having a viewpoint of the intrinsic value of an asset, being able to model it, understand what
Mm.
it's worth, and then from there, intuitively being able to make decisions to buy or decisions you know, to um, to divest. So I'd say I'd probably really kind of frame it that way. And I really do think the primary role of a CEO is to uh, be focused on capital allocation, regardless if it's a roll up or just a single product company. Because at the end of the day, you're deciding between funds for more inventory or funds for marketing or funds for an acquisition, and it's whether you're funding it all yourself or you're doing it with in a PE setting or doing it in a private setting or public setting. That's really what it comes down to.
Got it. And sorry to drill you down on this topic. It's obviously the topic I love the most, and I'm passionate about investing, by the way. So, um, how did you came to investing, and why did you start investing in the first place? And maybe you can share a bit more on your personal strategy in that. Not to get any tips or anything, but just curious to know more.
Yeah. So, I man. So if I go all the way back, so I was like probably 20 or something, and I was a sales rep for Mohawk Industries, and there was a RVP named Frank, who was on the tail end of his career. And it was funny, like he had this big sales meeting. Mohawk's a multi-billion-dollar company, and it was down in Los Angeles, and probably 120 people in the room. And he kind of like walks up to the stage with this piece of scratch paper and talks about this is like the annual meeting. Like, talks about nothing about the business. He talks about uh, our personal financial situation, making sure we have health insurance covered, short-term disability covered, the value of a 401k, in the 401k, what you should allocate funds to. I mean, this is like the strangest. sales meeting I've ever been part of. But what a gift, right? Like, I mean, he was very direct. Instead of using terms like, you might want to consider, he would be like, "You're an absolute idiot if you don't do this." Like, like, what's the point of working if you don't, put your put your funds away in assets that make money for you. So I think really that was an important part, for for me kind of early on, just getting kind of that dose of that kind of direct mentorship. If I kind of like fast forward kind of along the way, I would say when it came to when it came to uh, you know personally saving money, putting things away, I used to get jaded by things like, I'm gonna break all the good advice out there. So like things like the S&P 500 and all these funds. Hey, you should put your money into these funds and just trust on steady appreciation every year. But then you start diving in and realizing how many of these companies are like zombie companies. They don't do anything. They're just barely staying up and running. They have subsidies hitting and all that kind of stuff. And you see the returns coming from like a smaller subset within it. So then, like from there, I'm like, well, okay, great. You know, I don't like mutual funds personally. I like to, I don't like index funds really either, unless it's a niche index. And really, from there, if you're now thinking about things in that standpoint, you're finding investment advisors, or if you're doing it yourself, whatever, who are really focused on areas that you have like your core thesis, like for example, what's happening 5 or 10 years out, and then betting on the right companies who are well positioned within those. Ideally, going in heavy, going in early. Um, and so that's just the mindset. Like even with BuildDirect, coming in and kind of doing what we did. And so I would say like personally, that's what gets me excited. And so that framework of thinking applies to everything that we do, both at the company and also, I think, kind of, personally as well. I would say also like like the changes like to traditional finance and the access of information and the ease at which you can kind of view and analyze it using AI tools these days is fascinating. You can load in balance sheets and other tools, other statements into tools, and very quickly look for arbitrage opportunities, no differently than you can on like trading apps. And so I think the other part I would say is a lot of the development on the tool side has made it a lot of fun. But yeah, I definitely don't subscribe to uh, you know, just dumping cash into index funds to be safe and secure. Uh, I won't even talk about the bond market at all, but rather just having a thesis, what you believe in, where you think an industry is going, and then from there finding a handful of companies that you want to bet on within that space that fits your thesis. And then for me, the flooring industry is awesome. It's a huge TAM. It's very stable. It holds up very well in tough times. And in good times, does of course even better. It's a great industry that has steady growth. And then within that, I was looking for really the trends that were going to be driving it forward, and then getting a vehicle in place that really took advantage of that, which is, in my opinion, what Build Direct is all about.
Got it. So I'm going to ask a bold question. So if you don't want to answer it, it's fine. But how has that personal strategy done over time against the benchmark? I guess because if you're not beating the benchmark, like we spoke before, maybe your benchmark for building a new pro center is actually what you can acquire a pro center for, right? So maybe you could expand on that as well.
Yeah, so I would say, are you asking in regards to like Build Direct on like making an acquisition and what that would have looked like if you built it versus buy it, how that played out? Is that what you're asking?
No, I'm more talking about like your personal investment strategy.
Yeah, so the what I would say is I wish I started with that mindset sooner. Uh,
Okay.
since employing that mindset, it's been fantastic, and it's really no different than kind of what we've seen with the company company as well. And so I would say, yeah, against that mindset of kind of the younger years, yeah, definitely way better. And so, it does require you though to have an opinion, and then be able to recognize intrinsic value. So, like even with BuildDirect, no matter what the stock was, I had like a view of what the intrinsic value of the company was, which is to me all that matters. The only thing I care about personally is not what you pay for something; it's what something's worth. It's the most under asked question in investing. The most under asked question in investing is what is something worth? Not not what you paid for it. And then on that first question on what something is worth, it's if if any part of that answer has to do with like um the price action changes, that's usually a red flag for me. For sure, right? Because it's interesting, if you're like an active in the space, but most important part is what the underlying asset's worth, and then from there building a position against it, and then your capital, like your desired capital returns are just reflective of how much risk you're taking, right? If you think the asset's undervalued, and then placing it back kind of accordingly or waiting after. So yeah, I do like one thing I do like try to pass it forward is just the mindset of um, hey, look, when everyone works hard to make money in a variety of different ways, and so when you're when you're investing the money, just have a point of view, and you have at least some level of active interest in what that looks like, versus just kind of putting it out there into the ether and see what happens.
Got it. Perfect. So, circling back to M&A, maybe wrapping up that theme. If the M&A market suddenly dried up for 18 months, how would you pivot your strategy accordingly?
Yeah, so one way I kind of put it, let's say instead of dry up, let's say that there's two scenarios where M&A becomes more difficult. One is everything gets more expensive. Like let's say a private equity entrant came in. I wouldn't think it's strategic. That'd be a difficult deal from for a few reasons. Let's just say that there was a new like PE entrant and they just were carte blanche buying anything that they got their hands on, like kind of like all throughout the U.S. we have these signs in every like light post saying we buy houses cheap, call this number, sell a house, no sign unseen. Let's say like something crazy like that happened where there was all that happening. Um, until it kind of imploded, I would say we would just build. You just pivot to something else, or maybe just add on locations near your existing ones. The other end of it is if things got really bad. Let's say you had 6 months of just extreme pressure, and you're trying to catch a falling knife with deals where you're better off just waiting and then just doing like an asset buy on what's left, like through auction. So that's happened now a few times in the industry where there's some pretty big companies over the last year who just imploded over um, mostly inventory issues, and so you could catch them on their way down, or you just wait, and then just pick up some of the pieces if you're interested, or potentially some of the people. So those are the two extremes. And so in one case we would just build, and the other we'd either build or we just buy, convert, and build. And so that's kind of how I think about those two things. I would say though, like, look, uh, there are so many targets out there. It's a target rich environment, and so I don't really see either one of those things being an issue unless it was very much geography based. Let's say we need a location in a very specific area to kind of fill in the blank. That's where that could potentially play out. But with that stated, then there's a big map out there and a lot of other areas that we could pivot to as well. So, um, but yeah, I think I answered the question kind of in the spirit of it.
Yeah, 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 for sure. And for someone that has never run a flooring business, can you explain why is inventory such a big challenge for, because if these big companies are imploding, as you mentioned, it must be something hard to deal with, right?
Yeah, so I'd say there's for the most part yeah, so for the most part, if you're a pro focused uh, building material supplier, whether it be on like flooring, roofing, siding, so on and so forth, like ABC Supply is a roofing supply company, and they're just fantastic. Like Ferguson, they do a great job in this space. For a pro customer, you typically have just challenges on two fronts. One, you want to, if you can, skip a lot of the 2 or 3 step distribution to bring the cost down quite a bit, because you're buying in like large quantities. So you're not buying one window, you're buying 40, to be able to complete a new house build. Not buying, 600 square feet of hard surface, which is the average for like a big box store. You're buying, or for a retail store, you're buying, 4,000 feet for the whole entire house, because you're doing the whole house. And so when you're focused on that pro segment, the order quantities are definitely a lot higher. And where you have to be cautious and where implosion happens is when you're pulling up really deep inventory, but you get too wide. And so let's say, for example, you're operating in California and you open up a branch in Nevada. Um, and all of a sudden now the branch in Nevada is saying, hey, the inventory that we're using, the products in California, they don't fit this local market. So in that case, we need to have our own assortment, and everything goes fine until you do that 3 or 4 more times. And that's when the trouble happens. Um, and so I'm a big believer in finding that common thread, common set of SKUs that work pretty much anywhere. And then with that, not having, too complicated regional assortments that are also heavily inventoried. And so I would say that's really where the challenges kind of lie. And a lot of it's not super complicated. It's just having the systems and discipline and focus on those 1 or 2 really important pain points.
So why do these companies fail to manage that challenge?
So on a few fronts, first I would say the majority of flooring companies were kind of grown up from a single installation shop into what they are today. Like the industry doesn't attract a lot of professional management that really wants to make a career in the category. I think that's a very true statement across a lot of the less uh I can't think of a better word for this, just like the less sexy industries, like the meat and potatoes types of industries. And so with that, you don't see a huge influx of folks who are, you know, um, geared up for multi-chain location management. It's a uncommon skill set in an industry where most of the competitors are operating, one, maybe two, maybe three locations. I do think talent density in the industry definitely does matter. And what you find just very often, entrepreneurs do a great job building a few locations, but the more and more they build, very few are able to keep those broader organizations as vibrant as they were, really initially. And so you're talking about building scale. Let's say if you're building, like Waba grills, right? I like Waba grill. You have the same, kind of, retail mall footprint, the same assortment, same everything. You're just photocopying one after the other. There's not like local procurement decisions that franchise locations and have to make. You can have a single source that can supply all. When you get into categories like flooring or windows, so on and so forth, first off, you do have some regional differences on the product side. You have to fulfill them in different ways. And then second, you have installation, capabilities. You have to either outsource or insource. That adds a lot of complexity. And so these businesses they're not really set up to easily scale. So you have to have those systems and processes, really self developed. But that same comment you can make across pretty much any kind of building supply material or many other types of companies. When you have a service component, that's in there, and you have a category that has a high, ticket price versus, like fast fashion or things like that.
Got it. Yeah, yeah, makes a lot of sense, and I think it's always interesting to ask why do these people fail, or why do these big companies fail. So yeah, I think you answer it very well. You said I tend not to negotiate heavily on things I view as commodities. Straight price, take or leave. From a capital allocation perspective, it makes more sense to focus time and energy where there's real differentiation. Fair warning: most things are commodities. So, what isn't a commodity in your business, and yeah, how do you differentiate yourself?
I think I can remember exactly what I won't say it on this call. I'm pretty sure I remember exactly what I was referring to. And just for reference, yeah, like for my LinkedIn audience, it's an audience of one. It's myself. I just use my that as a place to record my
Yeah.
my thoughts, right, right or wrong. So like, that's a great question, right? Like when I think about things that can be differentiated. Let's you know let's think about, you're leasing properties, you have leasing agents, you're selling, a property, or, candidly, you're employing a company to provide services that you can do yourself, but you want to do in a more efficient way. So, for example, you're outsourcing something that requires a fixed cost or a tech stack that they have better scale with. You could literally, have your team members hop in the building and do as good of a job. But by outsourcing that, you can remove that tech stack, which is a common challenge with like e-commerce companies, for example. Those are all things that, in my mind, as just commodities. Like, look, is the carpenter better than other carpenters? Sure, but at the end of the day, you're putting on a roof and do it to code. Um, and then, from that perspective, whether or not it's done to code or not, it's not going to be a differentiating factor. Um, and a lot of things in my mind are table stakes, right? Like showing up on time, completing on time, this, that, and the other. Um, when I think about things that are not a commodity, like where you'll spend, time really thinking through and structuring, they tend to be more on the people side. So, like for example, when you're talking through potential acquisition and there's very deep relationships, and they're multi-pronged with a variety of different subsegments with a pro customer base and a market. It's not a commodity. You can't just go to the store and buy it. You can't do an RFP and have 45 different companies, respond back to it. And so I value those things quite a bit. Or a supplier who produces things on time, on spec, at a great price. Okay, ma- many do that. What's the value add? Are you bringing like innovative new ideas proactively? Are you waiting for a customer to specify them? Do you have alternative deal structures that could make it easier to grow with you as a company? I think a lot of that was, kind of stems from my time at Home Depot. Like, I'm a huge fan of Depot, by the way, very big fan. They do a great job with the homeowner customer. And, really having the expectation that your suppliers, should be your greatest strength on being able to drive innovation, was a pretty good, I think a pretty good way of kind of thinking through that one. So it's interesting because most categories, whether you're a like marketing company or lead gen, so on and so forth, if you just took what you did and restructured in a way that could solve a problem the customer had, that might not be great for you if you can't perform, like pay for performance models, for example, in marketing, then look at something different, something unique. But I find very often things aren't that, and so you set an expectation, you set a budget, you run RFPs, and then you move on. Um, Most companies on the leadership team, uh, this might sound a little strange, but most management have like two roles: that of the supplier, like they have customers they serve that they're delivering value to, and then on the procurement side, they are the customer, where
Right.
they have suppliers and they are the customer. and I'm much more interested in myself and team having the hat on of we are a supplier and we have customers versus the former. So um, not spending, a disproportionate amount of time on things that can just be, solved quickly, and then really having the team focus on our customers or where I get excited. And then, candidly, from the supplier side, having our suppliers obsess over our customers also on ways to better serve them are things I don't view as really being a commodity out there.
Got it, got it. And actually, you mentioned your LinkedIn is just for yourself, but I spent like 2 hours reading through your quotes, and it was a lot of fun because I felt like I was reading through your diary or something. It seems
You
like
were.
yeah, you're kind of speaking about specific situations without mentioning them and just giving an insight that you learn from it, or something like that. So I highly encourage shareholders that want to learn more about BuildDirect to actually go and look at Sean's LinkedIn. Hopefully he won't delete all the quotes in the meanwhile. But yeah, it was really a lot of fun, and I think I even texted one of your big shareholders saying, I think you should go through this because it's very insightful. Um, so my next question is, Floor and Decor has more SKUs and a bigger value offering. So why do pros choose Build Direct? And how does your sourcing and pricing differ? And what do you offer that Floor and Decor doesn't?
Yeah, I'm actually a big fan of Floor and Decor also for a couple reasons, which I'll probably take an opportunity to address here as well. So, kind of looking back, Floor and Decor was started by a team from Home Depot, effectively. And one of the big challenges they were trying to solve at Home Depot, it was more focused on like the weekend warrior. So you think about the average job being a bathroom in a hallway, and the inventory in the stores being at that level. And so when you now step it up to the next project where it's not like a weekend project where you're going to tackle the bathroom or tackle the hallway, but you're going to tackle like a much larger, let's say the living room and the bathroom and a hallway, that next like layer up. That's for Floor and Decor. Their format really, was focused. And so their average inventory per SKU was a lot higher than Home Depot's, but they were still focused on the homeowner customer, which is great. Great customer segment for them, and they're focused on building out in the early days, especially building out their footprint with a pretty fast payback model. I think the new stores like 10 million each, and they're targeting. It's been a while, but like I don't know, 35% or so return. Depending on what they were amortizing for the you know for the build. And so I loved also their very disciplined way of setting up the locations. But I would say with that, if you think about still like who our customer is, it's not the homeowner per se. It's an actual pro who's building their full business off us. So like
Right.
for example, our pro customers, they're not looking for, let's say, 1,500 square foot of a product that they can, have delivered to a house next Tuesday. They're rolling up looking for 3,000, 4,000 feet. And the lead time they gave us was like, I don't know, the half hour between when they left their project and when they arrive. And so it's the same thing with like ABC Supply on the roofing side, or any window company or Ferguson. It's a much, much higher level of expectation on inventory and quantity. The second part is when it comes to a pro. So if a pro, if they're not working for another retailer, like let's say you're an installation expert and you have a crew of like 2 or 3 people, and you're doing work for companies like a local mom and pop in town, or maybe for like the local Lowe's installation provider, things like that. Those companies are specifying the project, the material, the installation application, and then you're showing up and you're taking those things and you're installing it. You're not having to deal with the customer claims or issues, complaints, so on and so forth. That entity is handling all of that complexity. For the pro customer, it's just them. Their leads are self-generated. I mean, we do some things to help them generate leads, and we want to do more and more there, but it's just them. And so what they need is they need a very knowledgeable back office. So, for example, the pro will sell the project. They have products from us that are special, are specially designed for versatile, low claim, easy installation. But our team, if you look at our surveys and our feedback we get from our customers, uh, it, by far, it always starts off with product knowledge, installation expertise, and ties back to our team members. And so for us, the same thing applies to other building material. Um, I think wholesalers that do really well is they're providing the pro customer a lot more than just product. They're providing them with installation, expertise, claim resolution, interacting with the customer or their customer, so on and so forth. And so there's a lot more that's there that the pro has done for them if they're working on behalf of someone else. And so a simple check there would be uh, go to a big box competitor, anyone, and then walk in and ask 10 people there for help on fixing a subfloor issue before installation. They'll refer you to a website or to like maybe instructions in a box somewhere, or maybe their installation hotline where you can hire an installer. Our team walks you through the issue and how to resolve that. So, I'm not saying that we're better; we're just different. The level of detail and expertise that we provide is fantastic to a pro. Everything we do is built for a pro. Do homeowners sometimes shop with us? Sure. The same way, uh, other companies are built for the homeowner. Do pros sometimes shop there? Sure. But it just depends on what you're built for. Um, like you can't pull up to a big box with your truck, backed up and have pallets loaded on for a 5 minute turnaround. All of our locations are light industrial, retail mix. And so that's just like the service footprint that a pro is looking for. And that's how we've been, cautious on building our locations.
Got it. I think you mentioned there's something that is very interesting. You said you help your customers generate leads, and maybe you could break that down for me because, yeah, it's very interesting.
Yeah, so we find with pro customers, the biggest challenge that they often will have is they're running the installation crews that so they'll sell a project, then run the installation crew to fulfill that project. So it's kind of like 1 week on, 1 week off, 1 week as far as a week selling. I'm oversimplifying it for sure, but a week selling, job gets sold, a week installing, and then so on and so forth. And so having that like consistent flow has been one of the challenges. And a lot of the times, you kind of think about the gap between that and them themselves being a larger company. That's the hurdle they have to get over. And where it gets really difficult, they might be fine financially because they make a lot of money off the one project, but they're also employing a crew, and the crew is going to be typically paid on some kind of uh, pay for performance, like piece rate type of deal. If they're a subcontractor, there's different ways they're either paid or a daily rate or something. And so having, a crew on, crew off can be very challenging for them as well. And so I won't share too much about what we've built there, but that's an area that our company we're very good at lead generation, very good at lead generation. A lot of that stems from our e-commerce roots. And then with that, we also have the pain points, I think, pretty well identified and that we can address to help pros create a much smoother funnel. And so that's something that we are really focused on continuing to develop and improve. But I would say when you think about a pro, those are the two big issues they have. One is having the support on being able to execute projects, sorry, with their products. And then two is creating really consistent flow. And I think with those two things, as improvements get made, that'll help pros complete more and more projects and be able to offer their consumers better and better value. Because there's nothing like buying a project from the pro who's installing it. They 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 have a very good view of the right product for the application, and then on their side, if there are any issues or problems, it comes right back to them, not to like some third party or some retailer that then has to issue resolve the problem. You tend to find a much higher level of service and quality when you go that route. I think even personally, I've been very biased my own properties over the years. We tend to find people like that that will then do our projects, our work. We much prefer that experience over hiring a cabinet company or roofing company, so on and so forth. And so that to me was kind of like the genesis for like this, this love affair I've had with the pro customer, seeing how great quality work they do and being able to help them solve a few problems, be more successful.
Got it, got it. And so do you actually offer this as a service to the pro customer, or are you just giving this away because they're clients?
So there's two fronts. I would say I've talked about this, I think, in the past. Being able to provide a marketable service is definitely something on my team's mind. And then what we do today, a variety of pilots that we're doing kind of quietly in the background. So we don't want to get into too much detail on here, but I would say just to kind of to recap, that's like I'm intentional a lot about saying not just product but product and services. And when I'm saying services, I'm primarily referring to uh, the marketing side for pros.
Got it, got it. That's very, very interesting, because I feel like selling is a big pain point of most of these boring traditional businesses. And when I say boring, it's not in the bad way. It's like most of the people running these businesses aren't proficient in marketing or sales, or so yeah, I think that will be a huge gap in the market for you to address. Um, Now, also wrapping up competition, I have a listener asking, sourcing product, why is Build a better buyer than other players?
Yeah, so I wouldn't say that we're necessarily a better buyer. We're just going about it in a different way. So, and this was interesting for me, being from from the industry. So, I would say first off, the flooring industry tends to have a lot of middlemen, kind of throughout the value chain. So, you have a company who's positioned themselves as a manufacturer, and sure, they manufacture products, but then let's say half of what they provide is not. It's just coming through like distribution or a partnership of some sort. You have a lot of companies who like you know before all the tariff noise years ago, where you could just source everything from China, started creating supply chains direct from China. They were durable, they were great, they were for the most part, pretty consistent. And then many years ago, when tariffs started hitting, those supply chains got broken. They had to move to new countries. Now you're sourcing from a variety of countries, and so the for flooring, years ago, if you were a direct importer, that meant you were buying carpet probably from North Georgia. You were importing that, it was in the states. And on the hard surface side, that probably meant you were buying wood from China, along with vinyl plank from China. You're probably buying uh, laminate, which is effectively like fake wood made from layers of paper pressed together from Europe. Today, if you're a direct importer, you're probably buying from many countries all throughout Southeast Asia, which are each specialized in different categories. You could be buying tile from both Europe and also India. Laminate could be literally, choose a country on a map. Carpet now it could be also the Middle East, which is there's phenomenal manufacturing that's been set up, and it just got a lot more complicated. With that, a lot more opportunities for sure, which we love. But with that, companies started, just veering back to distribution companies that were willing to go through that complexity. And so at BuildDirect, one big thing that attracted me when I came to the company years ago was the fact that I had a great supply um, chain function, great procurement set up across many countries, and it was time tested, proven, and very well, in my opinion, structured. And so when I think about a lot of these, large players in the industry, I mean, even big box, in my mind, I don't think about them as competitors. Think of them as customers potentially, kind of where we sit in the supply chain. So that's really kind of how the company was initially built, how we've continued to operate it. And when it comes to the why, it's just, if you're in the industry, you saw it, you felt it. The same thing happened with like furniture, for example, where, years ago you're importing from just one country. Now you're having to import from a variety. And then with that, you have to be flexible because things can change for, things that are within your control and sometimes, without. So that's how we have structured ourselves and what we do. It's not like that's, you could repeat that play for sure, right? There's not like a patent against that play, but I would tell you, many have tried and not done well. And then with that, there's not like a huge pool back to the talent density of importing within our space outside of the major manufacturers.
Got it. Got it. Yeah, that's very insightful. And maybe I have a kind of a follow up here. So, when you say we buy inventory in thousands of square meters, which competitors don't do, they are buying in hundreds. Who exactly is buying in hundreds? Big box, other mom and pops. So, who you are talking about here?
Yeah, I was referring to not how much we're procuring, but rather the inventory that's available for customers. So, like for example, if you were to drive into your local Lowe's store or Home Depot, and you were to go over to just choose a product, what they'll have in stock is typically going to be, you know, in that in that range of like a small weekend project. Now, can you special order and have have a greater quantity delivered? Sure. Um, can you special order and have it installed within a time frame? Sure. Uh, if you go to like a Floor and Decor and you find something that's similar, the amount of inventory they have in stock for that product is going to be greater than the big box almost always. That's just kind of how they position themselves. But when you go to the same thing applies. Like go to a big box, you go to their door section. Can you find 5 doors that look alike? Sure. Can you find 40? No. Can they order them? Sure. Are they there today? No. Can you drive around at 5 different stores to pick them all up? I guess. Uh, but that's not what a pro wants to do. They want to back their truck up and have the 40 doors loaded onto the back of their vehicle. And so that's why Depot years ago bought HD Supply. That's kind of how they fit into that deal. And so I would say when it comes to homeowners, when you have a homeowner centric strategy, you want a lot of products, and with that, you have kind of shallow inventory. And the closer you get to the pro, the professional customer, you have a much narrower subset of products, but you have much deeper inventory. And so it's a different approach. So like BuildDirect, we sell to other retailers, and we are one supplier of many to kind of fill out that broad assortment. But for our business, being that we're centered on the pro, we're very much rifle focused on a smaller subset.
Nice, got it. So Sean, I'm very respectful of your time. So let me know how much you got left, so I can pick and choose the best questions, so we can then wrap up.
Yeah, so let's plan on wrapping up in about 10 minutes from now. So yeah, kind of
Sounds good.
go from there.
Nice. Okay. Yeah, so I have a bunch of questions here. Maybe I'll jump right into leadership, culture, and long-term thinking, because I think you have loads of interesting quotes on your LinkedIn. So I want to drill you down on that. Um, so you said, I get a steady stream of offers from firms promising investors publicity and paid coverage. Most go straight to the trash. But once in a while, usually when I'm bored, I'm in an airport, I'll reply, "Why would we pay someone to notice us?" That's when they fire back with ticker symbols of companies they've helped, quote unquote. I treat that as a public service. Adds a few more names to my personal do not invest under any circumstance list. I don't believe in investor relations as a shortcut. Just build a real business, tell the truth, and let the results do the talking. So, why are some companies paying six figures for IR services?
Yeah, so that's yeah, I forgot about that one. So okay, the to tell a bit of a story, right? Like so, BuildDirect is on the venture exchange, the TSXV, and so it's not abnormal to find companies who um, smaller exchange, less capital available, and looking to do X, Y, and Z. And I have no judgment against that at all. Like, it's not my companies do different things for different capital allocation, kind of purposes. But when it comes to, when it comes to what I've seen companies pay, uh, and for what they're getting, that that part that part for me, I have a hard time with. Just from like a pure capital allocation perspective, like if I'm investing in a company, I'm investing in a company through an exchange. I wasn't part of like a round that was strategic. I kind of just hopped on the wagon, right? I mean, if
Right,
you buy stock in a company, let's say you buy, some Tesla stock, uh, you know, should you get you hopped on the wagon, right? That it was already going a certain direction, not changing the direction. You're just hopped on, and you know, you can choose to hop off at any time if you disagree with how capital is getting allocated or time's getting allocated, kind of things like that. And so I kind of look at companies who spend a disproportionate high amount of cash relative to their overall balance sheet on things like that. Because intuitively, I think, oh, you're paying, make it up a couple $100,000 on your deal. You're expecting a ramp up. Then from there, you'll have some kind of dilution activity happen, and then it's all okay because it was a good ROI. Um, and I don't know, I have a hard time with that. When I think about when I think about investing in general, like it shouldn't be inbound to me. It should be outbound on what's interesting. And then with that, I also have a bit of a challenge when you're you know like when people are referencing one company being like another. Oh, this is going to be the Amazon of X, or oh, you're the X of Y. Um, yeah, I never liked labels. Just like having a strategy and kind of running after it. Um, and with from a team perspective, one big part as we're bringing in, kind of rebuilding the team years ago, and the folks we have today, just having a team that's not distracted by all that stuff. So I think a lot of it is just feeding your ego, um,
right.
and that's not a good place, in my opinion, to kind of to kind of be your to occupy. Some of that's also scar tissue. Yeah, I think in life you learn through both your victories and also your defeats. And so I'm a big believer in, let performance be the loudest voice. Um, it's okay to say what you're going to do. And then let your let your actions and really kind of support it. But I've um, never really cared for you know like just constant big hey, this is what's gonna happen. I'm gonna do. Like today and other calls, I reference most of what we've already done. That's kind of how we operate, as we talk about our to done list, not our to do list, um, and really go from there. So I don't know. It could be a harsh kind of point of view, but um, it's my point of view, and I really
Yeah.
believe it.
Right. So hopefully less hire firms or yeah, PR firms will reach out to you from now on
That's okay.
after they listen to this.
I say prove me wrong. There's
Yeah.
always that, right?
Yeah, yeah, exactly, exactly. So, if you could erase one common belief about running a business from the minds of every investor, what would it be?
You know, that's interesting. That's a good question. I would say probably this one's tough, right? Because I'll give an answer, but I also hope I hope folks don't really figure this out, right? Because it's great that they don't. It creates opportunity. It's kind of like AI tools, right? Like I don't complain about slow adoption. It's great because that's a pretty big leg up. Hope it stays that way for a while. I would probably say like the biggest thing is to always be thinking about things in terms of the competitive moat. Like, look, Buffett, brilliant guy. See the artwork. Fantastic voice. But the best music is done in a choir. You have more than one voice, and they hopefully they harmonize, not just like independent. And so, like for me, that mindset is it's an important voice, but it's just one of a few. And so having companies that have a competitive moat, um, look, that a lot of that's deep, very deeply in the industrial, like, economies of scale, so on and so forth. Or, very stringent patent law, which personally I have a problem with, huge problem with. I mean, look at what that's done to the medical industry. And so I would say like, look, you could be wildly successful, by, um, either fast following or just doing it better or staying more focused, more disciplined, and a lot of opportunities. And that in of itself is quite a feat. So, when investors ask me, why can't someone else come in and do what you're doing? I'm pretty direct. Like they definitely can. You can. You can start tomorrow.
Yeah.
Um, and you'll do fine, I'm sure. I still get hung up on that at all. But look, with that stated, I hope from an operator perspective, I hope people continue to believe that because I think most people are chasing, a unicorn, some idea that no one else has done, and only then could they be successful. And then, candidly, I think people think that or want that out of weakness. You want to have something that only you have, only you can do. So if your lazy butt doesn't get up every day and hit the gym and get it done, you'll still be successful. And here again, I don't want to live in that kind of world, or rely on some, protected thing, to where despite my performance, like when the other AI companies came out and, took OpenAI, uh, like out to lunch, that was fascinating to me. Um, that was great, right? Like when you saw Grok come out, DeepSeek. I was at a trade show with some folks from Asia and that hit, and it was just such an interesting, conversation. That to me, like competition is, I think where it's at. So just kind of wrap that up. I would say from an investor perspective, I think it's less about a competitive moat and more about focus and execution. Kind of more than anything. Yeah, that's probably what I would land on.
Got it. Okay, so let me just pick one of the last quotes here. Um, yeah, I think this is a good one to end up. You said, message to myself. If you see someone who has achieved great success, remember that the mindset, work ethic, and methods they have today are likely very different from those they had while they were building. The journey building required a different version of them than the one you see now. Can you expand on this?
What date was you're like taking me like back to my past here. I mean, pretty soon I'll have memories of
Yeah,
my long blonde hair. What year?
no,
When was that?
I literally went back like maybe a couple of years back. So yeah, it's very likely. I don't have the date here, but it's like maybe 3 years back. I don't know.
Yeah. So that's yeah. So I won't mention what group it was, but I was part of a network group. I remember posting that. It was actually the weekend that I took off from that group. And hey, great folks, great entrepreneurs, really interesting people to be around, but they just, uh, you want to know them 15 years ago or 20 years ago. Um, you know, that was the iteration of them. Like, I remember when I was in my early 20s, and I was building spec houses. This is like before the housing crash, like right before. And I was literally learning how to build houses, talking to a mentor on the phone. His name was Jim every night. He was in Oklahoma. I was in California. He was 30 years my senior and walking me through what to do the next day, like, literally step by step. And it was interesting because like that iteration of me is just a very different version of me. Same person, different time, different experience, different approach, so on and so forth. And so I think from that perspective, I really mean this. I love the access we have to old records, especially on YouTube. Right, like you can just find, like, there's a book from Andrew Carnegie called Business. Just the word business. That's how far back this goes, right? There's no need to have a fancy title. This is the book on business. Um, you can find that all the way to, like, early, podcast interviews from really great, phenomenal people. Um, and I listen to those and digest, like, the intent, like, ferocity in Jeff Bezos' eyes, talking about Amazon far beyond when it was successful, like in like the deepest parts of some of their challenges, is uh, is a different level of inspiration, far more than listening to, in my opinion, to now kind of reflecting back. Because there's memory bias, selection bias, all that kind of stuff, and so I don't know. Like for me personally, I like to be around that, but often I find you have to find that stuff in records versus meeting people in the fray there. Because if you just do that, you're also not having the benefit of interacting with folks who have achieved what you want to achieve. So I think finding a balance there. But with that, from a advice or mentorship perspective, that was a time in my life when I was shifting and moving, and kind of altering that mastermind group of people kind of around me, um, that had that were more in the fray and in the building stages versus those who are kind of in vacation mode and early retirement mode.
Yeah, for sure. I think I can also resonate with that when it comes to investing because a lot of the younger crowd like myself that starts studying Buffett and so on kind of starts with like the Buffett from nowadays, right? So
Hmm.
the last letters or the last interviews he gave. Whereas you should really be starting from the early partnership days in the 1960s. Those are the letters that are the most applicable to you because he was working with a much smaller capital base, and yeah. So I think
It's
that's
the
such a powerful insight.
Yeah, it's the yeah, like his early point of view, like his point of view later is diversify, just put money into a cheap low fee deal. But the way he made his money was extreme concentration risk. Cigar butt companies. That's where you tend to make money with extreme concentration early on, and then be able to control it by having an investment large enough to be able to control. And then, candidly, like my thought on that is, maybe his advice is because most people never will do the work
Yeah,
uh,
yeah,
to be able to place that extreme bet. Or if they do place an extreme bet, they'll do it off some random, piece of advice they got from some person, right? Versus doing the work on the intrinsic value of the company. So, yeah, it's actually a really good example, of yeah, what I was referring to. 100%. It's a great example.
nice, perfect. Yeah, so I think that's a wrap. Even though I had pages of questions left. I think we'll leave that for another day. And you were already very generous with your time. So, yeah, just wanted to thank you in the name of my audience for this 1 hour and a half that you just gave us.
Yeah, appreciate it. Have a great day.